Hey, it's Lindsay at Applied Mortgage. Today, we are going to review the housing projection for 2022. So let's recap a little bit about what we thought was going to happen in 21 versus what actually happened. So we did think rates were going to rise at the beginning of the year and recover in the fall. They actually came down a little bit sooner, and we saw really great interest rates as we went through the end of the summer into kind of the early fall of last year. Then rates did start to tick back up a little bit as we finished out 2021. Of course, there was really strong demand and tight supply, which was expected going into the market. What we didn't expect to happen was the huge housing appreciation that occurred. Some places, house values increased as much as 20%. So now we enter 2022, and the Federal Reserve is going to play a huge role in what happens this year, and they already are. We're seeing that happening. So a lot of these projections were completed kind of at the end of 2021 and have already sort of changed as we have turned the calendar year into 2022. So the Federal Reserve meeting has been meeting very frequently to talk about how to counteract inflation. What's interesting is that last year, throughout 2021, they were basically saying that they thought the inflation was transitory, meaning that it was going to just kind of solve itself. And they didn't really feel like the Federal Reserve or government needed to take a tremendous amount of action. Well, now they're pretty much doing a 180 and saying, oops, we probably should have done something sooner. And what are they planning on doing? Well, if you didn't know, the Federal Reserve has been buying a significant amount of mortgage-backed securities, trillions of dollars worth. That stimulates the mortgage market and causes rates to kind of artificially be held low. So they came out this year at the beginning of the year saying, surprise, we're not going to do that anymore. And also said, we need to increase our Federal Reserve's funding rate. So this all kind of turned the market on its head, and we're seeing mortgage rates react accordingly. Let's look at history for a second, and I'm going to make this a little bit bigger. So over time, throughout the last probably 40 years, these are just a couple of examples of when we've seen significant inflation, how the Federal Reserve reacted to that, and then what the response was from mortgage rates and also in the stock market. So these are two examples from the past here, the first two, and then the bottom kind of shows where we're at now. So in these past two examples, you can see when inflation was going up, mortgage rates went up. The Federal Reserve increased their rate to counterbalance some of the inflation, and then inflation came back down. And then what happens? Mortgage rates settle back down. What is a negative consequence, though, is the reaction in the stock market. This usually puts us into a recessionary time. So here we are on the bottom here with Powell and what's currently happening. You can see inflation has risen significantly, and mortgage rates, again, rise when inflation is up. The Federal Reserve has done a rate increase. They're also projecting that they're going to do more rate hikes in 2022 and 2023. This should drop, based on history, this should drop inflation, and eventually mortgage rates will settle back down. Now, will this put us into another recession? Of course, time will only tell. There are also a ton of wild cards happening right now. So we are in the middle of a pandemic still. Every day that new news comes out about the projections for COVID, that impacts what happens in the market. So it's really to be determined how the changes will happen. And we have to remember that this isn't a linear overnight change, right? Things happen and the market moves up and down accordingly. So what the Federal Reserve is saying is that they're definitely going to slow and stop their purchase of mortgage bonds. They're also going to hike the federal fund reserves rate, probably 2 to 3 times this year. I've heard maybe even 4 to 5 times next year. And when the Federal Reserve stops buying the mortgage-backed securities and doing all of this stimulus that they were flooding into the market, that increases mortgage rates. So that is why rates have been forecasted to increase as we go throughout 2022. Original predictions were saying maybe up into the high threes. Now I'm seeing possibly into the mid fours. It all depends on how quickly the market corrects itself and the inflation that's happening. If the correction happens quickly, then there are predictions that rates will settle back down. Barry Habib, who is a major economist that especially tracks the mortgage market and what's happening with mortgage rates, is predicting rates could settle down toward 3% as soon as the second half of the year. But of course, there are many wild cards, and we don't know when that will necessarily happen or if it will even happen. Freddie Mac, Fannie Mae, Mortgage Bankers Association, National Association of Realtors also came out with their own projections. Now, again, they kind of projected a little bit more linear as far as the increase goes. And on average, that maybe we'd get up to 3.7. Let's look at this historically. I really like this graph. This goes back to 2012, and it shows what has happened with mortgage rates over that time. So the interest rates, you can see if you kind of look on the average, the blue line, by the way, is the 30-year fixed rate. So let's keep an eye on that one. So, on average kind of here, 4%, great rate, stable economy, probably again, where we're headed. Right before the pandemic, 2018, 2019, we were actually up to 5%. And we were heading into a bit of a recession. Of course, the pandemic, which you can see right about here, actually spurred that significant drop and continued decline, where we saw kind of the base of the rates, the best rates here in at various points in 2020 and 2021. And now we're headed back up probably to these more normal economy levels. So what does that mean for buying power? If you're thinking about buying a house, or if you're working with customers that are thinking about buying a house, really important that they assess their budget. So this chart here is showing when rates were 3%, remember yesterday's rates, not literally yesterday, but last year, if somebody were buying a house in Hampshire County, the average purchase price is $370. And let's just say that person was able to do 20% down. 3% put their principal and interest payment at about $1,250 a month. Every time the rate increases, if you're still in that same scenario, 370 with 20% down, it increases the monthly payment by about $85 a month here. Okay, so 3% we're at $1,250, 3.5% we're at $1,329, so on and so forth. 4.5% we're at about $1,500 a month. This could mean that somebody who was wanting to buy a house for $370 when the market was at its low can no longer afford to do that. It may not be comfortable in their budget. So rather than buying a house for $370, it may mean that they need to reassess their budget and lower that purchase price a bit. So that brings me to the next question that everyone's asking, right? Will home prices come down? Well, all signs are really pointing to no. And a big reason for that is because there's such significant demand. So if you buy a house right now, the good news is that appreciation isn't going to go negative, right? You can see by this graph here, housing prices are projected to continue to increase over the next, 5 or 6 years at least, based on these projections. So a lot of people are concerned that they're buying at the height of the market and that market is going to crash. Most economists are predicting that is not the case. It's just that the appreciation is going to slow rather than house values going up 20% a year, which is crazy. They're going to slow to a more typical, maybe 3 to 6%. And then are we in a buyer's market or a seller's market, right? Everybody kind of wants to know that. So let me make this a little bigger again. A seller's market, which we've been in, basically means that inventory is low, right? There's less than 6 months of inventory on the market. A buyer's market means that there's extra houses for sale. There's greater than 6 months of inventory. And looking at this, you can actually see that we've been in a seller's market since about 2012. This isn't something new. Okay, that means there's been low inventory and high demand. Now, of course, this was even made more extreme by the pandemic and disruptions in supply chains. So we're seeing today stay really in a seller's market, high demand, low inventory. Well, what's the good news then for housing? The good news is, of course, other than being a seller and having strong property values and being a buyer and knowing that those values are probably going to hold, another great opportunity for people is that it's a really excellent time to think about refinancing. So if you bought your house maybe in 2018, 2019, or even 2020 and 2021, we saw those values significantly appreciate, sometimes as much as 20%. So that means that you have more equity in your house. Equity is the difference between what the house is worth and how much you owe on the house, okay? As a homeowner, that's your value, right? If you were to go and sell your house, you would get that equity. You'd get that money after you sold the house, after paying, of course, all the different people you pay along the way to sell your house. But you can access that while you still own the home. You can take cash out, real money, cash out of your property and use it for other things. Now, you can't borrow the whole amount, nor would you want to, right? Because then if the market does drop, you owe more than your house is worth. That's not a good idea. That's not what we're suggesting. And in fact, the lending rules don't let you do that. The lending rules are generally that you can borrow up to 80%. So that leaves you a pretty safe 20% cushion in case the market does swing. You can take that extra money and you can use it to pay off other higher interest debt so that you're bettering your overall monthly budget or household budget. You can use it to invest in other things, put it in the stock market where it's growing at a higher percent than mortgage rates are repaid. You could invest it in other projects, maybe buying other properties, for example. Or even I'm seeing a lot of people take cash out in preparation for their kid going to college or to pay off those student loans. So tons of opportunities to potentially look at how your house equity can work for you. Doing an annual review or just a mortgage review in general, if you haven't already, is a really good idea right now. So in 2022 in general, we're thinking the housing market will remain very strong. Demand might be slightly lower because buyers are getting a little bit deterred by rates rising and just have to adjust that mentality around what the new budget means. Supply might increase a little bit because people are getting a little more comfortable kind of moving and ready to list their house and having people come in and out of their house to view it. They're just feeling more comfortable about that in general. But we're also seeing an influx of buyers in the market. Their rents are rising, so people who are renting really want to be able to buy. People's wages are increasing though, which is a good thing. So it's opening up more opportunities to maybe save more money and then be able to buy. Also, millennials are at prime home buying time right now and ready to be a part of this housing market. So demand definitely very high in 2022. To be best prepared as a person who wants to either buy, sell, or refinance, I think the name of the game this year and always really is just be super clear on your goals and your wishes, your budget and your expectations. Understand your financial picture. Get help if you don't. You know, there are plenty of great loan officers, financial planners, accountants, people who can really help you understand your financial house, I like to call it financial housekeeping. Okay. If you're thinking about selling, talk to a realtor early, understand what the current value is for your house. If you're thinking about buying, get pre-approved early. Talk to your lender as soon as even 6 or 12 months ahead of when you want to be looking, just to make sure that you have everything together. And certainly if you're thinking of buying sooner than 6 to 12 months, then definitely definitely give us a call, and we want to help you put that plan in place. So work with a local team. Okay, there's a ton of resources, of course, online, and huge lenders and huge listing websites and all this stuff, but you just want to be very careful. Local team members understand the local market. We're vested in the local economy. We want the economy to succeed in our market. We have the contacts. So look for the reviews, ask for referrals, look for 5-star reviews online, and make sure that you have a really good team who's ready to help you buy, sell, or refinance this year. That concludes our 2022 housing forecast. As always, any questions, you can contact our team at Applied Mortgage. We are more than happy to help you with your house owning journey.